Trading is one of the most lucrative money-making machines available. You can earn thousands of dollars in passive income with just a basic understanding of the market. But for a beginner, the steep learning curve can be daunting. Without knowing what you're doing, you could end up losing far more than you had hoped to gain. That's why in this video, I will be taking you from cluelessly staring at graphs to knowing what tools you need to profit off of the market. Stay tuned, because I'll also suggest some bonus tools you haven't heard of in other videos. Let's start off with some definitions that you might be familiar with, but may not be able to fully define. The stock market can be viewed like a giant online farmer's market. Companies sell shares, tiny pieces of their business, to the public. The public can then trade that share amongst themselves, with the buyer having ownership of the share. These stocks can grow or shrink in value depending on a number of things. The most important influences are the company's perceived value and overall market conditions. There's a positive correlation between a company's good reputation and its stock price. It's key to understand supply and demand and how news can impact the market. The stock market is regulated by stock exchanges. There are two main stock exchanges you'll hear about: the New York Stock Exchange, which is the oldest, and the NASDAQ, where you'll find tech giants like Apple and Tesla. A stock market doesn't only sell shares. In fact, shares are only one type of something called a security, which is a tradable financial asset. Now, these assets are negotiable and fungible, meaning that two instances of the same asset hold the same value. There are quite a few types of these, but for our purposes, a security can mean a stock, stock options, bonds, futures, or mutual funds. Traders usually trade through a brokerage firm. These companies are middlemen who connect buyers and sellers so that they can trade these securities. We're going to get into graph analysis, and only after you are introduced to that will I tell you how to actually start trading, so stay tuned. Knowing how to analyze graphs is crucial in order to see where a particular stock is heading. You can think of them like a heart monitor, only instead of tracking your health, they're tracking the market's mood swings. Line graphs are what you'll see most of the time in trading, but allow me to introduce a better graph, the candlestick graph. Candlesticks show 4 price points: the open, the close, and the high and low of the price throughout the period that the trader specifies. The wide part of the candlestick is called the real body. The lines coming out show the high price and the low price. If the candlestick is filled in, black, or red, it means the close price was lower than the open price. If the real body is white or green, it means the close was higher than the open. Trading is often emotional, and understanding the patterns of candlesticks is pivotal to strategizing. All right, now that we've gone over the basics of trading, you can get some resources to use. To trade, you'll need a brokerage account. Think of it as a ticket to the market. Platforms like Robinhood and Webull are beginner-friendly, while TD, Ameritrade, and Fidelity offer more advanced tools. Make sure to research platforms to find out what's best for you, but we definitely suggest starting with Robinhood or Webull. But just using a brokerage is like walking through snow with a t-shirt on. You really want a jacket to keep you warm, right? So there are more tools available, such as Hoodwink Trades, an application that analyzes the market and tells you the best times to place trades. And of course, if you are ever confused about what's happening with a stock, Google is always there. There are two main schools of thought behind trading. There are day traders and there are long-term investors, and as such, you can imagine there being pros and cons to both sides. Day trading is where the young folk usually fall into. It's all about quick moves and adrenaline. Day traders profit off of smaller price movements over the course of the day. It's actually pretty regulated. The SEC requires a trader to have at least $25,000 in their account in order to day trade. If you don't meet that requirement, you'll be barred from trading anywhere for 3 months. 3 main risks are undertaken when day trading. Short-term price movements are particularly unpredictable, so the price may not go exactly where you think it'll go by the time you want to make a move. Leverage is often used in hopes of amplifying gains, but this can also lead to amplified losses. Trading stocks at a high frequency can mean that you'll have more transaction costs overall due to the high volume of trading. Long-term investment is just what it sounds like. It's more traditional, where the trader buys stocks in solid companies and lets it cook for as long as they want. That means less stress. But if you look away too long, sometimes a stock might run off the rails, and you might end up being too late to pull out without incurring a loss. But long-term investing is the kind of stuff Warren Buffett does, and that guy's super rich. The last thing to learn is having a good mindset. Trading isn't just charts and numbers, it's mental. Prepare to lose a lot. I mean a lot. The secret to being good at trading is to stay cool. Don't panic sell when prices drop. Don't sweat the smaller price movements unless you are day trading. Remember, even the best investors lose money. Use apps like TradingView to study charts and hoodwinked for execution. Stay consistent, stay informed, and don't let emotions dictate your trades. Now that you know the basics, where do you go from there? Obviously, it's time to start. Open an account, make your first trade, and keep learning. This is only the first of many videos on this topic being produced by this channel. So if you enjoyed watching, please like, comment, and subscribe so that you can see the rest of the series as it comes out. These videos take a lot of time to produce, so your patronage is very much appreciated. Until next time.